Question, how many of you going into the end of the year do any type of tax planning with your CPA? I mean, do you actually sit down with your CPA and say, okay, am I doing everything I possibly can be doing right now to avoid taxes? I'm just curious, show of hands. Anybody do it? All right, so here's the thing. This is why I always say, Brent does a fantastic job, and I can talk for myself personally. We sit down, November, December every year. We go through everything that's going on during the year, what we've done as far as any deferrals into, say, retirement plans or IRAs, or paying expenses here or there, to try to maximize ethically and morally, based on what the IRS has provided us, to make sure that we minimize our tax consequences as much as possible. And we'll get to the end of the conversation, and Brent will say, this is it. We have nothing left on the table that we can utilize. And that's the point I want to get to every single year. And if you're not doing that or haven't gone through that process at least one time, you need to consider it, because you may go through this process and there's nothing you can do. But you need to go through the process of planning at the end of the year in regard to your taxes, rather than bringing your tax stubs in, the 1099s, dropping it on the table and say, I'll see you in 4 weeks to pick up your tax return. Tax preparation, yes, everybody's got to do it. The tax planning is how you get ahead. It's just as important as the overall financial planning and investment management that we do. In some cases, more important, because we're trying to focus in on how you keep more of what's yours.
So just to interject a point there, I don't know what the percentage is, but I'd say maybe somewhere between 25 or 50% of the time as I'm doing a tax return, I spot something that says, hey, this could have really turned out maybe in your favor if we'd have done something before the end of the year. And so we are more proactive on it with our business clients like Trent. We have about 125, 150 business clients. So we're proactive with them as far as contacting them and doing those calculations and projections. With over 650 individual clients, it's hard for us to call each one of you and say, hey, do you have an interest in coming and seeing us each year? We just don't have the manpower and the ability to do that. So at any time during the year that you have a transaction that's going to take place, or you just want to talk more about your tax return, you're more than welcome to call the office and we can get that scheduled.
And then I'll add something in on that too. Remember when I said I do the tax planning, it's normally in the October, November, December timeframe. The reason is most, not just Brent, but most CPAs have a window that they really have time to sit down with you and focus on that, because once it gets into tax season right now through April 15th, it's a tsunami. It doesn't stop for them. So they don't have a lot of time to focus on outside of getting tax returns completed for the year. So take advantage of the October, November, December timeframe to do some end of the year tax planning. If you've never done it as an individual, do it one time at least, because you can see the benefits come from that. If you go through it and there's nothing else you can do, guess what? You got an answer. You're doing everything you possibly can. But I cannot emphasize enough to take advantage of that, because it will pay huge dividends if something is found. Okay?
All right. Well, good to see everybody again today. So, got our presentation to look at on the table. Obviously, you got slides that we'll run through, notes to put on the side, and then at the end, I think the other page is just kind of an evaluation of the course and some other things on there. So, we'll look at that as well. But obviously, we'll go through the presentation. There's the fun disclosures we always have to have, and we'll just look at the agenda. So, as Trent mentioned, big change this year, or got past the end of last year, is the Secure Act. So we'll cover that. Some more tax changes for 2020 of the normal stuff that usually always changes. Roth conversion opportunities. Again, we keep talking about that over and over and over again, but it's still out there. Healthcare laws. We'll talk about it. Distribution, a way to help keep what's yours. Give tax exclusions, and then kind of giving assets to charity. So we'll look at some options there. So for the Secure Act as well, I mean, there's some major things. There's a lot of things that happened with the Secure Act. It affected a lot of things, but there's probably like 4 high points I think we are going to look at today. Obviously, first off, RMDs. So RMDs was a big deal. the government kind of came out and said, hey, if you're not already taking your RMDs, and they used to be at age 70 and a half, you had to take required minimum distributions from your IRA accounts. They came back and now said, instead of 70 and a half, you can delay it to age 72. Okay, so kind of think about how the IRS does these things. The people that were already age 70 and a half taking RMD, there's no change. You'll continue to take your RMD from that end. But the people who aren't 72, they kind of gave you another 18 more months to wait and delay. So I kind of scratched in my head, and I was like, wow, I can't believe they pushed it, extended it, right? It's usually the government wants your money sooner. It's what they actually gave you a little more time. So it was pretty interesting. But again, that really looks at to give us more opportunity for more Roth conversions for the next coming years from that point. As far as the stretch IRAs, those are going to be gone now. So to give you people some idea, people may have heard of stretch IRAs. Stretch IRAs, inherited IRAs, beneficiary IRAs, they're all talking about the same type of account. So when somebody passes away, as a spouse, you still have an option you have a little more flexibility to say, hey, if a husband passes away, wife gets the account, they can treat it as their own account and move forward from there and have the account under just their name. If maybe mom passes away and then the kids inherit it, then it becomes an inherited or beneficiary or stretch IRA. Okay, it used to be able to take those. You had to take distributions automatically. So if a parent passed away, a kid was 20 years old, they'd have to take the distributions from those accounts from there to the rest of their life. They could stretch it over their lifetime, which for a 20-year-old could be a really long time. So that's why they call them stretch. Well, the government kind of got rid of that now, and they say, hey, there's no more required minimum distributions from inherited IRAs. They say you've got to have it depleted within 10 years, no matter what. So they're really expediting that distribution of assets, so to speak. Instead of somebody having maybe 20, 30, 40 years, if they're younger, they're saying you got to get it all out within a 10-year period. So that's a big deal. And that's probably how they're funding the RMD extension from age 72. I think I saw some article somewhere that said it added about $15-16 billion to the government over time. So that's pretty substantial from that end.
And one of the things about this new change that is spelled out here is that you don't have to take it out over once a year for 10 years. You just have to take it out by the end of the 10th year. So there's some strategy in play there as to whether you have other sources of income that you can minimize and then accelerate this in a certain period of time. So it gives you the ability to manipulate when you take this out, as long as you do it over a 10-year period of time, to where you could, maybe defer some income in some other areas and take all this out at one time to be more tax efficient.
Yeah, but again, there's some other small exceptions, of course, like there's all these exceptions from the IRS code, but that's kind of the main point from those. But definitely two major things: RMDs going extended at age 72, stretch IRAs going to the 10-year rule, right? The next two that we've got, the IRA side of it, might affect some people, is it used to be once you turned 70 and a half, you couldn't do contributory IRA contributions anymore if you were still working. You have to have earned income. So maybe somebody was working part-time job or whatnot, they had income after age 70 and a half, they couldn't defer money into a traditional IRA. Now you can under that act. So it might not affect a lot of people. But again, if you're that age and still want to defer, they've opened that window back again.
The only point about that is you want to be careful. There's probably not too many people that are in the job market at age 72, but if you are, you want to just make sure that if it's a minimum amount of income, that it's actually going to be taxed, because with the higher standard deductions and stuff, this earned income may end up being zero taxed. But then if you put it in your IRA and take it out 3 years later, it's going to be considered income to you. So there's some thoughts into just looking at your overall tax situation before you continue to do that.
Second part about 529 plans. So now if someone still has funds left over in a 529 plan, like a child does, but they have also student loan debt, or someone in the family has student loan debt, they can take distributions out of the 529s of up to $10,000 per person and out of your 529 plan and pay off the student loan. You used to not be able to do that. You can only pay it as you go along, right? So that's an option now if that becomes the case. Not sure how many people that will affect. I guess I was under the idea you kind of deplete the 529 and then you go to loans. But I mean, I don't know. Some situations are different, so they kind of give you some flexibility there as far as the 529 plans are concerned. Again, 529 plans can be moved around from beneficiaries like brothers and sisters, mom, dads, from that end. So, that probably could be where it could be a strategy down the road. Other thing that's not on here, I mean, there's like first time for adoption or child expenses. There's some exceptions there. I think that'd be the next thing that maybe the next bigger thing that affects the masses, that you could use some of your IRA funds to have an adoption expenses. Maybe if a young family or whatever, older family, whatever, want to adopt somebody, they could take money out of an IRA if they weren't of age to help with that. So there's a couple of things like that. There's a lot to do with 401ks and things of that nature. But so again, a lot of other rules happen here, but we just want to highlight kind of the 4 here. Any questions about any of those 4?
So you can take your money out, pay off a college loan, and it wouldn't be income?
You have out of a 529 plan,
Okay.
not an IRA account.
Okay.
I'm just going to make that clear. It's under a 5. So in the past, you could only use 529 plans. We use them forever, but for anything, but you'd have to pay a penalty if it wasn't a qualified expense. So, but now they say if you've got money left over, say you got $10,000 left over in a 529 plan, child is out of school but has $10,000 worth of debt, then you can take that money out of the 529 plan and pay the debt off without anything. Otherwise, well, you couldn't do that before this was passed. Yeah, major change. I mean, it's probably been over biggest change in the retirement side of the equation for about a decade or so. So it's a pretty big change. A lot of good strategies as far as Roth conversions and things that we can do since the RMDA just pushed out. And this will come up some more throughout the presentation, so we'll see some other ideas. This basically is just a chart showing the highest tax brackets or so in the past. All right, so obviously the illustration here is that, hey, we're still in pretty low and advantageous tax brackets. Again, this is from the tax plan that was passed, 2016, 17, and surely shows us as in pretty low tax rates when you look at it on a historical level. 1915, that's when tax return was first filed and everything. I guess the government didn't know what they were doing. They weren't taxing a lot of people, and then they shot it up. But obviously, 45 was in the World War II, and it kind of scaled down from there. But right now, we're just saying, even if this is the top tax bracket, in the whole scheme of things, we're still in pretty low taxes overall.
The tax brackets we were just looking at is tax on ordinary income. That's your retirement plan distributions and things like that. There's also another component to your income that's called capital gains. That's if you sell a capital asset, whether it's stock, land, or other types of highly appreciated assets. And also your ordinary dividends that come out of your stock accounts. And so we have 3 different tax brackets that income could be taxed at. I would assume most of us would rather be here than here.
Yes.
But if your overall income falls within the first tax bracket here of 12%, then there is a 0% tax bracket for capital gains income. It doesn't apply to all the income, but just those capital gains transactions. And so if you have if you have an activity, if you have something that you're thinking about doing some disposition, I can't tell you how many times Trent's came in my office and said, hey, I've got a client that's going to sell this, and here's some of the parameters of their tax return. Do you think they're going to stay in the 0% tax bracket? So we can do those calculations and we can do those analysis, but it takes some forethought to do that because you may have to slow down some other income, maybe some IRA distribution, some other discretionary sources of income. But with some planning, you may or may not be able to fit into that 0%. Otherwise, most of us are going to fit into 15%, and probably very few of us are going to be in the 20% because you have to have over $400,000 worth of income. So with some planning, you may go from 15 to 0.
And this is going to be something that I'm sure everybody's heard of, kind of tax harvesting strategies towards the end of the year or whatnot, just to see, hey, where's my income going to be And this is only on accounts that are not IRA accounts. So these are accounts that you have non-qualified or non-IRA accounts. So like individual brokerage account, a joint brokerage account, whatever it may be. That's what this is talking about from that end.
And you may not want to wait till the end of the year because you've gone all year and taken, a pretty healthy amount of IRA distributions out of your IRA account. I don't know of any way that those could be put back into the account. So if you're, if you have a house, some real estate or something that you're raw land you're thinking of selling, then you probably want to do this. You want to strategize this so that maybe you can control your income sources for that year and fit into that bracket.
What has actually changed?
This has been around for about 3 or 4 years now.
Yeah.
This concept has.
Okay.
It's just a matter here again of a calculation of your tax return and where your overall tax return falls into what tax bracket.
Yeah.
If your overall tax return falls within a certain overall bracket, then the capital gains portion of it is taxed as 0. So it's really a calculation. And like I said, if you were going to sell something and you had the ability to control your other sources of income, if let's say you weren't 72 and you didn't need to take money out of the IRA, but you're doing it now to subsidize your income, maybe you turn that off and use the proceeds from the sale of the land, hypothetically, to be your source of income from that year. You're trying to isolate that income and maybe not have as much other, because if you do that, then there's a chance that you'll stay within these parameters. And if you do, then that income is going to be taxed at 0%.
Yeah, the 0, 15, 20 has been around for a little while, but every year, as the brackets get adjusted, those are kind of where your ranges of income change from the 0, 15 to 20 from that end. But I mean,
this is about $100,000 of income here. We've got some slides that show you some strategies about the 12% tax bracket. But if you're in if you're married filing jointly and you have about $100,000 worth of joint income after the standard deduction, you still remain within this 12% tax bracket.
And this is something that's always been up for debate a lot, is saying, hey, even no matter what, how much your net worth is or whatnot, if you can do proper tax strategies to kind of be in the 0, 15 or even 20 range, it's been talked about trying to adjust those for new tax plans. I think I've heard about it a lot.
And this refers to long-term, so you just have to have held the asset for a year. So that's important to remember.
Yeah, anything short-term would just be at your regular taxable bracket at that point. So yeah, you got to hold that, 1 year,
Yes.
1 day, right?
It's a 1 year holding period.
1 year. Okay. Social Security, payroll taxes from this end. So might not affect people in the room that are actually retired from that end, but these are the strategies. So every year the threshold gets changed. Once somebody makes, in 2019, once somebody made $132,900 in wages, they were no longer able to have to pay the Social Security payroll taxes. It kind of stops. 2020 just kind of got a little increase, for inflation or whatnot. So now somebody makes $250,000 a year, once they hit $137,700, they no longer pay into Social Security and payroll taxes for high earners. Again, another big thing is up for debate as far as tax changes from Republicans versus Democrats from there. Again, higher income earners are not deferring after they make that much. So the super mega rich can probably do that in 1 month and then don't have one to not pay into it anymore, So tax deduction strategies, obviously just take a look at which account should I make contributions to, right? If I'm doing pre-tax 401k or traditional IRAs, should we use investments that are non-qualified into tax-deferred type accounts to help things? Obviously, always look at asset allocation. So again, just some different things. Business owners obviously can have a lot more room. If somebody owns their own business from that end, as far as what retirement plan they want to set up. Can I set one up that allows me to defer more than just a traditional IRA? Am I able to do things like that? So there's a lot of planning that could come around with business owners.
These are all just traditional strategies that, here again, you just want to decide how much of it you want to defer and save versus at what level you want to go ahead and pay the tax. If you think it's at an affordable rate, then you would just take each one of these into consideration to try to plan what you want your tax to be versus what Trent said. maybe not take it all into consideration, and then the answer is what it is after the fact.
Again, these are some of just the changes that usually occur every year, just increasing some deferral ranges. So the 401k limits change. Obviously, it was $19,000 what someone could defer. Again, that's what they defer into a plan, 401k plan. It doesn't include matches. That just kind of got to step up by $500. So now you can max out a 401k at $19,500. From that end, 50 or older, you get a catch up. Again, was $6,000. It got another increase to $6,500. So those are pretty common things that happen from year to year, having those increases. IRA limits for what you can do on contributory traditional IRAs or Roth IRAs, that didn't change. That's the same. You can still just do $6,000 per person per year. Do have a catch up here as well of an extra $1,000. So if you're over 50, you can put $7,000 in per person per year. Again, you have to have earned income to be able to do this. Distributions from IRAs or anything doesn't count. You have to have earned income, W-2, 1099 type income.
If you work, a lot of people are under the misconception if I work and I'm covered under a company sponsored plan, then I can't take an IRA contribution deduction. But pay attention to this side of the slide, because if your income's under a certain level, not only can you contribute to your company sponsored plan, but you can also make individual contributions and kind of have a double up effect. But there are some income limits here when they talk about a workplace retirement plan, and so you just need to be mindful of that. And the concept of a workplace environment plan means that if you're eligible to participate in it, then you're considered to be participating in it. So you would be subjected to these income limits as to whether you could put the money into the IRA or not.
Another thing that obviously we'll look at here on the bottom, the Roth IRA. So if you make, again, if there's a single and the married filing jointly ranges, if someone is working and they have wages above that, they make too much money to contribute to a Roth IRA. When you look at Roth IRAs, there's a lot of different kinds, right? So you got your contributory Roth IRAs here, which you gotta stay within the income limits to make your contributions. Then if you're fortunate to have a 401k plan that also has a Roth option, there are no income limits in that. So that's one way you can access a Roth if somebody makes over that much money to get some money in a Roth account. Okay, and then you've got conversion Roths that we'll talk about too here in down the next couple slides. Conversion Roths, there's no limit. It's just based off of what makes the most sense to convert during that tax year to stay at a certain tax bracket. So the Roth conversation can get kind of confusing because there's kind of so many different types. Contributory Roths, conversion Roths, Roth 401ks. They all have got different rules. So I just want to kind of point that out for a minute. So here is kind of the other chart that we had the bar graphs on. This kind of shows it a different way. You've got your tax rates. Again, 2018 is when they really changed for going forward. So here's your different tax bracket levels. The highest being at 37, lowest being at 10. All right, so then it talks about in 60, 63, these were kind of your lowest, 26, highest 87. All right, so again, it shows that right now I'm all right paying some 12, 22, 24% in taxes. Future rates, again, can we see this again? I mean, who knows? Obviously, I hope we don't. But we've been there before in the past, so that's really just what this is showing from that end. Couple of changes on the other side. Qualified Roth distributions are tax-free, not subject to Medicare tax. Don't add to your gross income. So again, we always talk about maybe having different buckets as far as a strategy to pull income out of. You have like a pre-tax bucket, like your pre-tax 401ks that most people have, pre-tax traditional IRAs. When you pull money out of those, you're taxed at whatever tax bracket you're in when you pull it out, right? Roth IRAs, when you pull money out of there, it doesn't show up on the taxes because you've already paid tax when you did the conversion or you did the contribution way back when, right? So you got to have it's good to have different buckets to pull different types of income from, depending on where tax rates are and what your needs are. We'll talk about the Health Care Act, Affordable Care Act, ACA, Obamacare, the Unaffordable Care Act, whatever you want to call it. They have, there's strategies you can put in place as far as Roths are concerned to qualify you for subsidies. So again, that's part of the ACA planning that we try to do a lot with people that want to retire prior to age 65 and still have to pay health insurance because it's not cheap, right?
The strategy on all of this, and we've talked about Roth conversions quite a bit now is that I would assume not too many people in the audience here would have a problem paying tax at 12 or 10%. And so if you have room there every year that you're not filling up that bucket and you have qualified funds, let's go ahead and peel those off and volunteer to pay tax at that rate. Because here again, would you rather pay at that rate or would you rather pay at these rates? And we don't know what the future holds. I mean, if you do, I'd like to know. But what we're saying is that we're constantly doing that analysis towards the end of the year with Trent and Brandon to determine whether any of our clients have room at that 12% layer. And we have some folks that also say that, hey, I know that if I've got $1 million in my qualified plan, I'm probably, I made 22%, may be even a good tax rate. And so we'll probably drill down into this into other slides, but just want to emphasize that there's nothing wrong with volunteering to go ahead and pay tax if it's at an efficient rate.
Sir, is there a limit on how much you can take out of a traditional and move it into a Roth?
So that's what I was saying. There is no actual IRS limit to the government say yes or no, you can't do it. But you got to do it at a limit to where, so a married filing jointly couple, say they have $60,000 in income in the year. Well, they can probably convert another $45,000 out of their traditional IRA to their Roth IRA and still pay just 12% tax on it. So it's gonna be dependent on where your income is, right? And as Brent was saying, we've got some clients that maybe they're lucky enough to have a pension, or they have some decent IRA assets. Their lifestyle's good, so they're always going to say, hey, you know what? I'm probably never going to go out of this 22 bracket. They're already there, and then we say, well, the next bracket's just 2% more. Depending on where we're going, 2% more doesn't really sound too bad. You've got a lot more room at that point.
Well, notice here, this 22% is the third layer of the bracket. Over here, it was the first layer. And you don't have to have a lot of income to go from the first to second layer. And the answer, as far as a limit, there's no monetary limit. It's just a limit of how much you're willing to endure in paying taxes with current rates. Do you think that it's 22% still in light of this or this is 22% something, or do you want to draw the line at 12%? So there is no hard limit. It's just a matter of what every person's thoughts about current rates are versus future rates.
Is it like the 22% of just what you convert, or is it 22% of your whole income that year?
Our tax system is a graduated rate, and so that income, you assume that it's going to stack on there last. And so if you're already filled up, I call them brackets, but if you already fill up these two buckets, then your distribution is going to come in at whatever it's generally stacks on top of that. That's the way I try to explain it to my clients. It's the easiest to understand. You may take it out the first day of the year, but your tax return probably looks pretty consistent every year, and you're saying, hey, we've done the analysis, and yes, I've still got $50,000 at the 12% bracket. Now here again, what a lot of people ask me is that, hey, when I trigger here, does it make everything subject to 22%? And no, it's just any extra that exceeds or fills up into the next layer. These are all taxed in layers. And so it could be that you have, out of 50,000, 40 taxed at 12 and 10,000 at 22, but it's a graduated calculation.
Is military retirement considered income on that one?
Yeah, it's like as you pay taxes on it. Is it taxable military retirement? None of it's disability related or nothing like that. I mean, so it's kind of like, hey, I get $1,000 a month, and I can withhold taxes out of it, and that $800 or whatever.
Well, it's not a pension. A pension is not an account balance that you have your hands on. You don't have a handle to that. A pension is a guarantee of an income stream. And so you can't call the Department of Defense tomorrow and say, hey, I want you to go ahead and send me, 3 times as much as I normally get on my pension. But if it's an account balance plan that you get to decide how much you want to pull out, then that's what we're talking about as far as this whole umbrella of qualified plans.
But the income you receive from the pension would be calculated into your tax bracket as your overall tax bracket for the year. And again, like Brent said, that's a lot of people don't realize, and we'll talk about it, is that it's a like I said, graduated cylinder marginal tax system. So everybody, no matter who you are, some people, Bill Gates even pays some income at 10% probably for the first 2 seconds of the year. But he fills that bracket up, goes to that bracket, and then goes up to the top, right? So then that also is key, because when we do those calculations with Brent what I like looking at is the last page. It'll show, hey, your marginal tax rate is where your last dollar fell into. So your last dollar could fall into the 22 bracket, and that $1 would get taxed at 22. The rest of them would be kind of taxed at a blend from that end, right? So, you got a marginal rate, which is where your last dollar went in, and then you got an effective rate, the actual rate you actually pay taxes at. So you might marginally be at 22 in that scenario, but you still effectively paid 12, 13% really in taxes. This is kind of an example of what we've kind of been talking about. Just kind of put the pen to paper and look at it. So married filing jointly couple, it says they can make $80,250. That's the top of the 12% bracket. And then add in your standard deduction, and then that equals $105.50. Yeah, $105,050, and you're still in the 12% bracket. So don't forget about the standard deduction that's out there for married couples. So that's kind of an example of the calculation.
We think, when we talk about 12%, everybody thinks, well, gosh, maybe that's only the first $25,000 or $30,000 of income. But the 12% bracket for married filing jointly stops at $105,000. Well, the bracket actually stops at $80,250, but because if you're married, you get the new higher standard deduction. So then $105,000 of gross income would equate to $80,000 of taxable income because of the standard deduction. Let's forget the fact of whether you itemize or not. We'll just give you the standard deduction. So really, just use a rule of thumb of $100,000. That's how deep my bucket is for married filing jointly, that I can pour this money into and still stay within that 12% bracket.
Another misconception that we kind of hear too is that people talking about, well, I can't use my mortgage deduction and insurance deduction for it anymore if I'm still paying on my mortgage. Because I itemized, and I was, they're at $18,000 itemized deduction before this increase happened. Now the government's saying, hey, yeah, you did 19 this time, but hey, we're going to give you 24,800. So yeah, you don't get your mortgage interest deduction isn't doing anything for you, but they're actually getting more by the standard deduction that they gave us. So it's a give and take thing. So just to be concerned about that. This one talks about the 22 bracket. Just gives another example of what that looks like. I mean, we've done conversions of like $5,000 before, or we've done like $80,000. We've done conversions because someone that's in the 22 to the 24 bracket, they can actually have a lot more room. Jerry, you got a question?
It was going to be pretty much to clarify what you just said, unless you have more than 24/8 in itemized deductions, there's no reason to be capturing receipts for donations made to churches or mortgage or whatever, right?
Yeah, I had a client that said that. He's like, man, because he had a bunch of medical expenses he would do, but it never going to go over that amount. So he's like, that actually simplified my life because I don't have to track down all these mileage receipts and medical receipts and stuff like that. So so you don't have to keep it. So that also gives a strategy of like, well, if I itemize and it's below that, does it make sense to kind of speed up the payoff of my mortgage? And that just depends on, that's a whole other conversation, but now that's a little more of a viable solution. So I like freeing up cash flow if your interest rate's not super high, right? You kind of weigh a bunch of those scenarios out, see if it helps.
Our approach is, if you take the time and bring in your itemized deductions, we're going to put it on the schedule because North Carolina does have a lower standard deduction than this. And so sometimes it will flip over to where there'll be some benefit. If you're close to this number, then more than likely you may receive some benefit on the state tax return. Now that's not significant because it's taxed at 5.5%. But anybody that we prepare their taxes for, if they go ahead and take the time to do all that, we're going to put it in the system just to see what benefits are going to flush out from it.
This talks about some disadvantages. So again, obviously, as Brent said before too, it's just like for someone to decide, do they want to pay tax now than later? I mean, you really are kind of rolling the dice, and trying to say, hey, what if tax rates go down in the future? Well, they could. Nothing's impossible, but they're pretty dang low right now. So historically, we just say, hey, you got a pretty good, we think you got a pretty good chance, but that's everybody else's personal decision, right? So, one thing that could say, hey, should I have done that in the past? Well, no, I shouldn't have if tax rates go down, all right? So that would be, man, I shouldn't have done that. But if tax rates go up, even by 1%, you made the right decision to pay taxes at a lower rate, right? When you're looking at earnings, there's earnings from that end. Because again, think about it. So to take Roth out, or do a Roth conversion from your traditional pre-tax money to a Roth, the payment is you got to pay your taxes now. You still got to come up with those taxes somewhere, right? If you're under age 59 and a half, you got to pay for it out of pocket. I had a young guy, he was in his mid-30s. He converted a $30,000 IRA, I think he had, and he was going to pay taxes out of pocket because, he's mid-30s. They got a long way to go for that money to grow tax-free until he gets to retirement, right? So his goal is to try to convert it everything as much as he can. So he had to pay those taxes out of pocket, out of his cash savings or whatever. If you're over 59 and a half, you do have an option to withhold those taxes off of the conversion. So if you convert 20 grand, you have to pay your taxes, your net after that's going to be lower. So that's less amount that can be able to compound. So again, it kind of just really depends on how you're looking at it. A lot of people, if they're 59 and a half, they do take it out of their amount because they don't want to come out of pocket with it. So again, those are just individual conversations we can have to see what makes the most sense from that end. So if tax rates stay the same, and you made a Roth conversion 10 years ago and at the same rate, 10 years later, it doesn't really have any effect. So you're good from that end too. So it's weird how that stuff works out. But these are just some disadvantages from that end that might think about it. But again, main thing, if cash rates are lower than they are now, shouldn't have done that, so to speak. But so healthcare laws. This is talking about the exclusion. You want to touch on that?
So a lot of people may not realize that there's more than one type of tax that you may be subject to. We all talk about income tax, but there's also the concept of a wealth transfer tax. And that means if you die, this used to be significant years ago because the exemption used to be around $250,000. And said if you died and you had transferred more than $250,000 to your heirs, then that excess would be taxed at some pretty high tax rates, around 40%. And so I would say that if we polled the audience, probably a large portion of us would have all of our net worth of more than $250,000. Well, guess what? Congress has done us a real favor now. We don't spend a whole lot of time on these slides because now it's almost $12 million per person. That if you pass away and you transfer wealth to the next generation, that you're going to be below the exemptions. However, there's this concept of what's called the gift tax law. The gift tax basically, remember the old 250 rule? Well, Congress, the IRS basically said that, gosh, everybody would just kind of know that maybe a couple years before their health declined, they would just get rid of all their assets before they died. Well, that's when a gift tax came in. It's the same concept. Whether I transfer the assets during my lifetime or whether I transfer to death, this concept has to deal with the transfer of wealth. This exclusion basically says that I can gift $15,000 a year to any one recipient and not have to file a gift tax return. The IRS keeps a big scoreboard in the sky that says that, hey, during this person's lifetime, how many times have they made taxable how many times have they transferred gifts? And they keep a scorecard of it because here again, years ago, it wouldn't be hard to get over that $250,000 threshold. So all we're trying to say is that there is there's another set of tax law out there that has to do with the transfer of wealth. And the bottom line is we don't really need to be concerned about, what we're going to leave our heirs, but you do need to know that if I transfer more than $15,000 to any other recipient, you're supposed to, by law, file a gift tax return. Now, it's not going to be taxable because you're going to basically, if you gave $20,000, $15,000 is excluded by the annual exclusion. You're going to take $5,000 out of your $11 million. So this is here to backstop any transfers that you make during your lifetime also. So I get calls periodically, and everybody thinks that, gosh, I made this gift. How much tax am I going to have to pay? I transferred the deed in my house. How many times does this happen? I transferred the deed in my house to my kids. Well, guess what? You just made a gift. And I guarantee you the house was probably more than $15,000. So you were required to file a tax return. You could chop off $15,000 of it there. The rest of it comes off of your $11 million of your backstop for your lifetime. So the emphasis here is that, hey, probably none of us in this room need to worry about death tax, but we need to understand some compliance requirements. And that is, if we transfer property over a certain amount, we are supposed to report that to the government.
Remember, that's also $15,000 per person too, right?
Mm-hmm.
So,
You can take that, and if you gave 10 people, you could give away $150,000 because, so it's based on each person you give it to is allowed to receive $15,000 with that exemption.
another thing, again, slightly increased from last year to this year. I mean, again, another thing that you hear Congress talking about changing, kind of lowering down those $11.58 million. I mean, like Brent says, $250,000 in the past. That's when a lot of people were setting up trusts, and there were big things because they were trying to shelter assets. But now not so much of a huge issue. So we got a massive amount. I always teach this class sometimes just to the general public, and I'm like, hey, if you got this problem, you come to me, let me know. You know, so if you got $22 million, this is what I kind of touched on earlier with the ACA, that's the Affordable Care Act, again, Obamacare, whatever you want to look at it as. It used to be that when that first rolled out, if you didn't have health insurance, say in 2018 and prior to that, you had to pay a penalty to the government because you didn't have any, which is kind of weird, I guess, when I first heard about that. It's like, well, if you can't afford the health insurance, why is the government going to penalize you and cost you more money if you can't afford it to begin with? So they kind of did away with that in 2019 and they continued on in 2020. So, you know, that's what we'll look at. Future Affordable Care Act, I mean, this is a big deal. Obviously, we get people that come in and work with us and they say, hey, I want to retire at 62. Again, the first question is, what's your health insurance going to be to get you to age 65 in Medicare? You know, nobody really wants to wish their life away, but, you know, getting to age 65 was a big deal. I remember my dad kind of works for himself, so he doesn't have health insurance from a company or nothing like that. But him and my mom, I think, were paying like $2,500 to $3,000 a month for health insurance. And we just had a big party when he turned 65 a couple of years back because it just saved him so much money to get on Medicare, right? So the future of the Affordable Care Act, I mean, it's a question mark. This is all what we call, you've got market risk out there, right? And you've got legislative risk. Tax laws could change. The Affordable Care Act could get wiped out. Something else could replace it. They usually always adjust it every single year. So again, when we have somebody that's kind of wants to retire at 62 and they got to bridge the gap for 3 years and their plan is to go on the ACA, we got just full disclosures that we only plan for this year by year and see what it looks like and what changes happen, right? Because you don't know. It could be available this year and go away next year. You might not be able to qualify for it. Is that a risk you're willing to take, or what's plan B, right? For plan B, I might find a job with benefits, or I might try some pooled insurance, you know, whatever it may be. So it's just key. Legislative risk is a big deal, and that legislative risk also involves where tax rates are, right? So, and everything else we've been talking about.
So can you clarify for a minute, this itemized medical expense, contingent upon 7.5% of AGI, how does that correspond with the 24.8 of the itemized expenses?
Sounds like a CPA question right there.
So your Schedule A, if you visualize your Schedule A, the very top of the form is your medical expenses, then you have your state income taxes, then you have your mortgage interest, and then the last one is your charitable donations. Mm-hmm. So if that whole bucket exceeds the $24,000, you can use Schedule A. But starting at the top of Schedule A, you don't get all your medical deductions. You only get your medical deductions if they exceed 7.5% of your income. So if your AGI was $100,000, then you're going to have to subtract $7,500 from your total medical expenses, and anything above that slides over to the column that gets added up with the rest of the stuff to see if it goes over the standard deduction. And so, you know, if you had $10,000 worth of medical expenses, $2,500 of that would be in the deductible column, and that would get added to your state income tax, your income tax, those others. The bottom of that page, then you compare that to your standard deduction level, and you're going to elect to take the greater of the two.
Got it. Thank you.
If you think you may have been subjected to the healthcare penalty, in 2018, there was an exclusion that said if you lived in a county and that county only had one healthcare provider for that county, then there was an exemption for the healthcare penalty. And so Rowan County, about 46, how many counties do we have?
100.
Okay, so there's only about 4 counties. I looked at a map when I went to my tax class, and there was only ever in Raleigh and area Wake County and stuff like that. But most of the counties in North Carolina only had one provider, and a lot of it around here is Blue Cross Blue Shield. So one of the exemptions to the penalty says if there was not fair competition in the county, and for some reason you didn't have health insurance, you could make a waiver, and this would go away. So if you look at your return and you see that you were subjected to the penalty, you probably ought to amend that tax return and ask for those monies back.
Distribution wise, when we're looking at, again, ways to keep money that's yours. I mean, just kind of look at, again, this really just comes down to tax rate. Say, hey, what income do I need? What sources is it coming from? When the tax, I'll give an example, when the tax laws changed to these lower brackets, we had some clients that were taken out of, say, non-qualified individual or joint accounts to subsidize their lifestyle. And when those brackets kind of reset and went lower, we say stop those and let's start taking money out of your qualified accounts because we're paying 12% taxes on it. So it all depends on kind of where we're at tax rate wise and where we should do it. How we're saving money. Again, should I? I met with a couple this week. 51 years old, never met with someone and just trying to figure out, hey, what am I doing? Is it the right thing? They wanted to retire before Medicare age, so they have no Roth bucket. So they didn't have an option in their 401k plan either. So we're gonna start trying to build those Roth assets. And they says, are we too early to come in? I'm like, no, there's no such thing as too early to come in, because he wants to work for probably 10, 11 more years. Let's start building up a Roth bucket for 10, 11 years for both of you, so you can then pull on that if ACA is still around by then. I mean, who the heck knows what it's going to look like 10 years from now? But again, these are some of the things of how to save money to maximize tax deferral, or look at the Roth side of the equation.
I mean, this would be fitting back to that 0% capital gains rate. Hey, I need X amount of money to live each year, so can I take some of it out of my Roth account, which would not be taxable? Can I take some out of my savings or money market account? So this whole concept is if you've done the planning with Trent and Brandon, and you have a plethora of buckets to pull from, then you can decide each year how much I'm going to pull from which bucket. Some of these are non-taxable, some are taxable. You can decide what tax bracket I want to pay tax in. If you pull it all out of the taxable side, you're either in 12 or 22. And here again, if you have a significant capital gains transaction you're thinking of, then you definitely want to get ahead and plan what your income's going to be for that year.
This is talking about QCDs, or qualified charitable distributions. We got a whole slide about it, so we'll talk about that. Should be coming up pretty next. Brendan kind of already touched on this, the gift tax exclusion of $15,000 from that end. Here's an example, again, we covered already, that it's $15,000 per social security number, I guess, if you want to say it like that, as far as your gifts are. So we pretty much covered that one. So I'll go to the next one. Here we go. Here's the QCD side of the equation. So when you're looking at the QCD, so qualified charitable distributions used to be attached to the R&D age. Well, the R&D age now is increased down to 72, but the QCD age didn't change from 70 and a half. So what this is talking about again is, and there's kind of a chart down here below to look at it. Again, we've given this presentation to churches, other charitable organizations, for people that need to take their RMD, some at age 70 and a half, some at 72 now with the new law. That they can take money out of an IRA account, send it directly to the charity, and satisfy their RMD, and it's also not reportable, or you're not taking any taxes out of it. So therefore, charity gets their chunk, and no taxes are taken out of it. So it's a really, really big deal for individuals as a planning strategy. So here are some of the parameters of it. You give up to $100,000 per year for it. And again, money moves. If you take it regularly, if you say you take money out of your accounts, you maybe give it to a church or some other charity, hit your tax return, and you're good. Maybe you tithe every Sunday, right? Well, kind of a smarter way to do it for multiple reasons is to kind of take it all out front. Take it all out in January, February, send it directly to the charity up front, so they're getting a larger chunk right now instead of a little bit all throughout the year. Doesn't hit your tax return and also satisfies the required minimum distribution. So it's kind of a win-win all the way around. So that's a really big deal that we've able to kind of shown this to a lot of different organizations, charitable organizations, to really drive up some giving from that end. Because the standard deduction is so high now, we might not be able to get your distributions to charity or Goodwill's not really helping you at all. This is a way it can help.
And Brandon just touched on it. So what we're really saying here is if you look at your tax return and each year you claim the standard deduction, now remember you have to be over 70.5, but if you claim the standard deduction, but you're still giving $5,000 or $10,000 to charity, then you're also in the situation where you're required to take money out of your IRA account. So under the old way, I'd take $10,000 out of my IRA account. It would increase my income. I'd write that $10,000 to an organization. But guess what? I didn't get really a tax benefit from that, because if I give $0 to charity or $10,000, I'm still going to get my standard deduction amount. So then Congress, really a real pro taxpayer benefit, said that, hey, just take that money and send it directly to charity. It's not going to go in your income page, but you're not going to get a deduction for it. And guess what? We didn't need the deduction because we claimed the standard deduction. And so it's something that's probably being underutilized. I know Trent and Brandon are really doing it, but here again, and it doesn't even have to be your required minimum. If you're doing $10,000 to the church and you're only allowed to take out $1,000 a year, you can do above that up to the $100,000 level. And so you just ought to take that into consideration, because it'll definitely improve your tax situation by leaving all of that off of your tax return. And there's only two little tidbits to say about this from a practical standpoint, and we saw this year, and I don't think it's going to change. The 1099 that gets reported, if I took out that $10,000, you're going to get a 1099 for $10,000. And when you take it to your tax preparer, it doesn't say anywhere on that document that I sent that money to the church. And so if you took it to H&R Block, you took it to whoever, nobody's going to know. They're going to put that in as taxable income. You have to be proactive and let your tax preparer know that this $10,000 1099-R that I got, it was sent on to an organization through a qualified charitable distribution. Now, unless they change the reporting mechanisms of that, which I don't know that they have, it's going to say total distribution 10,000, taxable distribution 10,000. You have to go in and override that through your computer software.
It hadn't changed.
The last,
I got one this week.
did you? Okay, good. We got confirmation that hasn't changed, and so somebody's made and here again, you could have taken 50 out, which 10, so it's going to say 50 total, 50 taxable. So you have to be mindful if you do this, the communication and what the document looks like, or that is very easy to be overlooked. The second thing is the IRS did say that even though you're not going to take that as a charitable deduction, you have to have a statement from the charity that says that you gave this and that you did not receive anything in exchange for it. You have to have the typical charitable donation receipt, even though it's not being claimed as a deduction, it would be disallowed otherwise. And so there was some question, a lot of people said, well, do I still need to get a receipt from the charity if I'm not itemizing my deductions? And the answer to that is yes, you still have to keep that in your records.
And the other thing about that is you got to be careful, because you got to do it a specific way. Not all custodians out there or firms can do it. I was working with Fidelity that they do allow us to do basically what they call third-party checks. So we got to send a check directly out of the IRA account to the charity. They can't send to you and then you take it to the charity, right?
Well, I've been in some classes that said that you can do that. Now, I don't know if Fidelity's advising you, but as long as it's made out to the Boy Scouts, to Meals on Wheels or whatever, you know, we all sometimes like to get a little pat on the back out of boys. So if you stop by the organization and hand them a check, they don't know whether it came from your IRA or whatever. So So I think you can take physical possession of it, and I don't know if Fidelity's.
That's what we've done. We have the check made out to it.
Send it third party to the charity.
Yeah,
Made out to the
they can't send a check out to Brandon and then I deposit and then I write a check out to the charity. The charity has to be on the check itself. Then yes, we can mail the check to your address and then you take it to the charity. That's not a problem. You just can't do it the first way I said from that end. So again, a lot of good strategies, a lot of good ways people can raise a lot of money for doing it from that end. You also got donor advised funds too. That's where you can drop a lump sum dollar amount into a donor advised fund, get a tax deduction during that year, and then you can just kind of pay charity out of that account as needed, as you want to. So
we'll see that periodically. Brent will meet with a client and they want to they've done pretty much everything they possibly can do as far as reduction in taxes, as far as reduction in income. But the last thing that we can take a look at, one of the last things, is that donor advised fund. So you can set those up and go ahead and accelerate your giving now. And you can make a decision where that money goes later.
I'm sure you've heard a lot of professional athletes that have their own private foundations, like Tiger Woods has his own private foundation. Well, the concept of a donor advised fund is basically the same. If I sold a piece of property for $500,000 and I said, I don't really know who I want to give it to now, you can just drop it into a donor advised fund. You're going to get the charitable deduction in the year you put it in that fund. You could take the next 5, 10, 15, or 50 years to decide how you want that doled out. You don't get a deduction the second time. You get the deduction when it goes in, but it's kind of like having your own private foundation where you get to pick and choose how you want that money to be dispersed over the future.
His example of that would be if you've got $10,000 that you give to charities every year, and all of a sudden you decide, hey, I'd like a deduction this year. Well, you can give 10 years worth of your deduction into a donor advised fund. You can lump sum $100,000 in there. And then that way give $10,000 a year from that donor advised fund, but you're going to be able to deduct that on your taxes the year you give it. So it's a different strategy to overcome the standard deduction, which Brent had talked about.
So again, honestly, we covered a lot today from that end. It's all about looking at where tax rates are now, how to plan for that, track it on an ongoing basis. Again, everything Trent and I do is monitor the financial plan. That's how it drives all of our decisions. So I always say it's a living, breathing document, and it's always going to change as life changes. So when everything comes up, let us know. We'll see what's going on, and we can test it in the plan. Had a call today that we did that too. So tracking, the monitoring portfolio is really, really important. So just to make sure we keep that all the way up to date from that end. Questions about anything that we covered or didn't cover?
Is there a certain time when a minor only receiving unearned income, the parents have to claim that? Or can that minor always claim it? Files his own tax?
Minor's working, but
No, not working.
Not working.
It's all.
There's no limit as to how much they can receive. There are some calculations that are a little complex. It talks about the kiddie tax, where the kid may have to pay tax at the parent's income level. The IRS kind of puts that in play because they don't want you to shift assets into your child's name and enjoy a lower income bracket. They'll let you get away with that with a little bit, but if it's much, then the child's taxable income is to be taxed at the parent's level, and this is on unearned income, not like a part-time job or anything.
Do you know what that amount
I don't think that kiddie tax is a little more complicated, so I don't have those parameters in front of me. I wanted to touch on something just real quickly because we batted around this whole concept of standard deduction, and I won't take but a minute because I'm not sure where we're at on time, but there's this concept that if you just have to look at your Schedule A and you say, gosh, I had itemized deductions of $15,000 this year, but we claimed a $25,000 standard deduction. The question becomes, if I took those deductions and I bundled them together in 1 year, if I did 2 years worth of deductions in 1 year, would that be enough where I would go over the standard deduction? And sometimes that can be the case. And you'd say, well, I'm not sure what you're saying. So what I'm saying is there's some things that you have discretion on when you pay. Other things like your mortgage, the bank's not going to let you pay it every other year. But donations, so you become an annual giver. Well, gosh, I'd like to give the church every week. Well, the church is not going to close its doors if they don't get your check every week. you become an annual donor. And so the way you would start this is in 2020, and here again, this is gonna say great, this is purely from a tax perspective. So you don't make any donations in 2020. You take all that money and put it in a savings account. You wait and pay your property taxes at the end of the year in January of the next year. So then you pull your money out of the savings account and you make your 2020 donations in 21. You make your regular donations in 2021. So you've got 2 years worth of donations 1 year. You have 2 years worth of property taxes in 1 year. Plus, if you have a little mortgage interest to throw on top of it, you would have to do the calculations yourself, but you may have enough every other year to beat the $24,000 to $26,000 standard deduction. And so here again, all it takes is saying, I'm not going to give this to the church every week. I'm just going to transfer it into this savings account that I'm earmarking for it, if that helps you feel better. And so so in 2021, you would basically make 2 years worth of donations that year. You would make 2 years worth of property taxes that year. And we actually did the calculation with someone that I met with, and sure enough, they had excess every other year to the tune of about $5,000, maybe. I don't remember the exact, but $5,000. If you're at the 12% tax bracket, 12 and 5, 17% of 5,000. Don't know what that number is off the top of my head, but it's enough to get you a couple steak dinners. And if you're to 22 and 5%, then that's 27%. Let's say it's a $10,000. That's easy math. I can do that. So at 22 and 5% state rate, it's 27%. Well, 27% of $10,000 is $2,700. Well, I think that probably has some meaning to most of us in this room. And even if it's at the lowest bracket of 12 and 5 to 17% on 10,000 be $1,700. So either one of those dollar amounts could have some meaningful savings, and it's just a concept of bundling. Nobody says you have to. These are your discretionary payments. Rowan County gives you, I think, around the 5th or the 10th of every year to pay your property taxes. You don't have to have your property taxes paid by December 31st. So every year, it's a matter of just saying that, hey, I'm going to make one payment in January, I'm going to get the other payment in December. You're a tax basis taxpayer, so it's whatever you do within those 12 months that go to your bank account is how your itemized deductions are computed.
But you also got to figure percentage more you paid in taxes. You also got to consider the more you're going to pay because of the interest by holding that money that you're going to give to the contribution.
So is that a good thing? I mean, yeah, if I put it in my savings account and draw a little bit of the interest income, that's pretty good.
You're taking part of your state money.
I mean, that one didn't. That one kind of went over my head, but.
I mean, if you paid your property taxes when it's due, when it first comes, you get a discount.
Oh, you're talking about the little discount.
Yeah.
Well, Trent's got his magic calculator back there. He could probably tell you how much you're going to earn in 3 months by paying it early. I mean, I've never paid my property tax early, so I don't know what that equates to. Probably 1 or 2%.
Yeah, it's really, really low.
Yeah. So anyway, it's just a concept to think about. You can play around with the numbers and see if it maybe works for you. I'm sorry, you have a
The
question.
general rule or rule of thumb is that if you think you're going to live past 80 or have a good chance, then you should wait till 70 to retire if you can afford to do that. Is that?
Now, my assumption is, I don't know if you're talking specifically about your Social Security benefit or just.
Social Security.
Okay, and I know we got 2 experts in the room that are experts on Social Security, and I bet Trent's dying to answer that question.
No, go ahead.
Hey, listen.
All right,
This guy-
I'm actually getting the
Are you
answer
doing
from
that
this unearned credit. right
Okay,
now.
well, go ahead, Brandon, answer that
Yeah, I
question.
mean, the whole idea behind Social Security is that it's all about how long you're going to live, right? If everybody knows where you're going to live, it'd be very easy to do this, right? So, but basically, how Social Security works, at age 62, you can take it early. And then you get to your full retirement age, depending on your age. For a lot of people, 66 and some odd months, or 67. I'm even at 67 right now. So that's my full retirement age, right? So every year between 62 and 67, your benefit increases by 6%. From 67 to age 70, your benefit increases by 8% a year by the government. Okay? So the whole idea is what you're saying is the longer you wait, to maximize it, wait till 70 if you can afford it. Because the idea behind that is that the government's kind of guaranteeing me 6% on this side of it and 8% on that side, and nobody can guarantee you that in your accounts, right? So just to kind of delay it as long as possible. usually a husband-wife scenario, we say, hey, let the lower spouse Social Security start first, and then you've got the higher earning spouse delaying theirs, because when the higher earning spouse then passes away, then the other spouse gets that amount. So those are Social Security's planning strategies from that end. So
To answer your question, am I gonna bet on myself and my longevity, or am I betting against myself? If you wait till 70 and take it and you die at age 71, guess what? I got 12 months worth of Social Security. Nobody else is gonna get that. It doesn't pass on to my kids, my siblings, spouse, or anybody. And so you're really just thinking about my longevity. If I would have backed up and started it, yes, it would have been a lower amount, but if I started at 65, I would have had 5 years worth. It's a function of math where somewhere there's an imaginary line out there where you break even. Where you say, if I wait and I live this long, then my higher payments are gonna be this amount, where if I draw earlier, the accumulation of those, and I'm not sure what that axis is, but somewhere in the future.
88, 89. Age 88, 89. If you
88.
Yeah.
78.
78, 79, excuse me.
Okay. Well, I was like, 88, you better draw
Better do
early.
it now.
That's a long way.
78 to 80, you can run 1,000 different ways. 78 to 80 is going to be your break even for husband and wife.
You wait
So
to
it's
70.
just a matter of betting on your longevity.
Is that your wife retiring at the same time you are, or does that depend on her age?
It depends on the age, the income, all that stuff. I mean, it's
Right.
Social Security is an individual calculation, so,
One goes
one
on
could
the
draw early and one could decide to defer, so they're, separate elections. It's not joined together, so it's an individual election. One may decide to draw early and one may decide to defer. And
Okay.
I know these guys do a lot of analysis in that area.
Yep.
Between husband and wife, one of you wants to wait to at least full retirement age 66 months or 67 or longer. Most of the time, we try to push it to age 70. Because if we get to age 70, especially if there's an age gap between husband and wife. Maybe there's a 5-year gap or something like that between the two of you. If there is, it's absolutely imperative that one of you wait, or the oldest wait until 70. Because you want to secure that benefit for surviving spouse if something were to occur. It's
But-
huge.
But then does it matter about the younger spouse? I mean,
Chances are
what
the
I'm
answer,
thinking is my wife will just retire at the same time I do, but that's not.
it won't impact, because the surviving benefit that she will get from that will be the higher of the two. And most of the time, that's the
Okay.
age 70 amount.
Okay.
But yeah, inside the plans that we run, it shows you all that scenarios, and it shows you Social Security scenario. It says, what if I take it, if we both take it as early as possible, or if we both delay it as late as possible? And then it'll show you everything in between, and how much money cumulative you got from pulled out of the system, and then kind of what your break-even age is. So yeah, 78, 79, not 80. So,
And under the income question, 1,100 and below, you don't have to worry about it. It's for children. So 1,100 and below, non-taxable, between 1,100 and 2,200 at the child's rate, anything above 2,200 at the parent's rate.
2,200.
Yep.
I
That's-
don't know what we're talking about.
That's for 2020.
Social Security's not part of this, just got one question for the answer.
Sure.
If my wife was lower income, start drawing hers at 62, I wait till full retirement, and she only gets a little bit. Once I start drawing, she can draw half mine, right?
She should get the 50% of what your full retirement age benefit is. What happens is she continues to draw hers, and then they supplement the difference to get it up to 50% from your bucket.
But
It
since
doesn't hurt your bucket at all.
Yes, I understand that, but if she draws a 62, is that sort of her base of how much she's gonna get, half of mine?
Great question. So yes, it's 50% of yours minus the early withdrawal
Early
penalty,
withdrawal,
which would
okay.
be 6% of yours. That's right. Good question.
yeah, Social Security can be. I mean, again, that's a whole nother strategy within it. Obviously, some things we touch on. Even the taxation of that. There's so many different rules between earnings test and taxation of Social Security. So that can be a whole thing by itself. We can talk about that for an hour. But
We run into Social Security also on these Roth conversions, because here again, if you're making $40,000, $50,000 a year, more than likely your Social Security benefit's not taxable. So you have to make a conscious decision that, hey, I like this 12%, I want to drive my income into it. But if you do, you may create some income that's otherwise not taxable to be taxable. And that's just part of the equation that you have to work through. just to determine that I think this is overall a fair, effective rate to pay taxes on these funds, because I don't really know what's gonna happen in the future, and I do know that I wanna pay tax on a certain amount of this money right now.
Like I said earlier, like as far as the planning is concerned, if anybody knows anybody that can need help with this kind of stuff, I mean, it definitely makes a difference. My example I gave earlier, the 51-year-old was looking to say, hey, am I too early? When I ran his plan and I'm changing what he's doing contribution-wise from pre-tax to Roth so he can build his Roth bucket up, when I ran it to his end of life expectancy, it made about a $500,000 difference if he makes changes now versus if he keeps doing what he's doing. So there's things like that that's pretty eye-opening, and I didn't realize it was going to be that huge, but it's just, I mean, it's pretty neat to see something like that. So, definitely keep us in mind if like I said, someone's nearing retirement from that end, or 10 years out, or whatever it is, just to try to get some of these concepts down, because there's a lot of moving parts for sure. Also, join us on social media. I actually did a video on the Secure Act itself, kind of highlighted those 4 points. If you ever want to see that again, we have a YouTube channel, which is probably the best way to see it, or our website has it as well. We're trying to get all of our other videos. We made a little change back in November, so we got to get all this stuff reapproved. So we're going to try to get all the old videos that we have up there as well, and we'll just continue to do the educational videos and market update videos as well to try to keep everybody up to date. But a lot of good resources and things we try to put out, and obviously do these classes as well. So. But thanks for coming. If you didn't have any questions, obviously we'll be around. So.